Hi guys, and welcome back to the Broad Investor channel. For those of you that liked, shared and subscribed in the first video, thank you very much. I really appreciate it. I hope you liked the second video. If you got any questions, please put it down in the comments below. And for those of you that are new to the channel, please like, share and subscribe if you are willing to become a broad investor. Thank you. To my second video. So for this one, we're going to be speaking about for the potential of a recession taking place, and I'll be talking to you guys about stocks that actually do well during this period. Now, in summary, for this particular video, we're going to be speaking about what a market bubble is. Don't worry, I will be elaborating on this point later in the video. We're going to be talking about how the market bubble, or the stock market bubble actually, is relatable to a recession. We're going to be speaking about what a non-farm payroll is. For those of you that don't know what non-farm stands for, it's essentially most other industries that do not pertain to farming. Okay, we'll speak about a list of stocks that do well in a recession, and I'll be talking to you guys about my current stock portfolio. Okay, so let's get into it. Alright, so what is a recession? Some of you might ask. Okay, this is the contraction of an economy in 2 successive quarters. I.e., if Q1 and Q2 the economy contracts, that would cause a recession. Okay, there are many factors that can cause it. A loss of confidence in investment and the economy is one. But this time around, if a recession was to take place sometime in the foreseeable future, it would be due to an asset bubble burst or deflation. Okay. Now, to know what's going to happen in the future, or to estimate what will happen in the future, we must learn from the past, and we'll be looking at the economic contraction of the US GDP. As you know, the last recession that we had was in 2008. Okay, now the economy shrank by 8.4%. That's the US economy, and already for the first quarter of 2020. The economy has shrank by 4.8%. Now this is all showing you in this particular graph on your left hand side. If you come to the table on your right hand side, if I just explain to you guys what some of these columns mean, reference, what you're seeing here is Q on Q. For those of you that don't know what Q on Q stands for, it's essentially the quarter on quarter. Okay, we'll be speaking about the actual, that's the actual results that were taken, what the previous year results were, what the market consensus was for that quarter, and the TE forecast. TE in this instance meaning the trading economics forecast. Okay, Q on Q is normally broken down to 3 different stages. Normally it's the Q on Q advanced, Q on Q second estimates, and Q on Q final. As you can see, for Q1 of 2020, the advanced was estimated to be around negative 4%, but the actual was negative 4.8. Okay, so the final will be around negative 5, and this is the biggest drop of GDP since the last quarter of 2008. Okay, if we look at Q2, T forecast a negative 17% in GDP for Q2, which is relatively high, especially if you compare it to what they forecasted for Q1. Okay, so that's not really boding well for Q2, and Q1 has not been good. It's been terrible actually. But let's examine that a bit more. So what's going on is what I'm really asking myself, right? So, because in 2020, as you can see, we've had a really bullish run. So this is a graphical representation of the S&P 500. As you can see, for the year of 2019, we've had a really good run, and this has come to an abrupt and quite sharp end in March 2020, obviously due to the quarantine, as the S&P 500 fell to 2,566.5 points. Okay. But then we've had a sharp rise, as you can see here, and things have gone back to normal. Now, how can that be when people have been in quarantine and not been able to work, and a lot of people have been laid off? Well, this is when the Federal Reserve stepped in and eases the financial burden. Okay, They do this by a scheme called quantitative easing, which we won't be speaking about for this video. But essentially, the Federal Reserves, or the Fed, what they're known as, is they've essentially printed money out of thin air to bolster the economy in the short term. This move in turn reduces the value of the US dollar because there is more money than the number of products and services. So this sharp rise, as you can see post March, is not an organic growth of the S&P 500 stock market, but rather one that's been created by the Fed as they've been printing money. Okay, now if we speak about how much money they've printed when it comes to giving it out to the recipients of this bailout, it's actually been 985. The bulk of that going to banks and other financial institutes. A lot of it also going to Fannie Mae and Freddie Mac, which are the US economy enterprises. And they've printed 634 billion, which they dispersed to these recipients. Okay, so now we know what a stock market bubble is, because obviously this sharp rise is due to the Fed stepping in and giving out money. Okay, so last two slides weren't really particularly good slides. They were pretty negative in what the economy is telling us, but hopefully this one is relatively better. Okay, so the question here that we need to ask ourselves is the stock bubble going to burst and lead to a recession? Now let's look at the table here on your left hand side. This is the S&P 500 index. Okay, for the year that we're currently in, the annual change that they are predicting is negative 1.14. Q1 and Q2 for the GDP was pretty grim. Okay, now it's highly possible that Q3 and Q4 would yield a positive and much needed growth. Okay, this is possibly resulting in a less disheartening annual change for 2020. That doesn't look too bad, does it, when you compare it to negative 17 and negative 5 for Q1 and Q2 respectively. Okay, so for the market sentiment, what you're seeing, market sentiment, for those of you that don't know, is how the traders' attitude is to trading. As you can see, for the week, the first week of June, this was pretty high at 34.55. This is much higher than what it was in May the 7th, as this was 23.67. So since then it's been growing every week, other than May 14th, when you can call that an outlier. Okay, now what I didn't really speak about in the previous slides is the bailout tracker in too much detail. Now, although the US government had dispersed 634 billion to 985 recipients, a lot of these companies actually returned that money. The total return was actually 390 billion, which is more than half of the 634 they've printed. Okay, so it's not all bad news, and Fannie Mae and Freddie Mac actually has provided a dividends of around 312 billion, if I'm not wrong. Okay, so not looking too bad for Q3 and Q4, and hopefully things pick up. Okay, now this is even going to be more positive, because what we're discussing here is non-farm payroll statistics. In the month of April, 20 million people was out of employment, unfortunately, in the US, and that was caused due to the quarantine, of course. But unexpectedly, in the month of May, the US economy added 2.5 million jobs, which is the most recorded in 1 month. Okay, so this graph is showing you that the month of May was pretty high for what it represents. Okay, now if we come to the table here on your right hand side, you can see it's similar to what I presented to you guys about the GDP. You have the previous, and the consensus. And you can see for the month of May, the actual was, in terms of non-farm payroll, 2.5 million positive, okay, not negative, as the market consensus is at negative 8 million. Okay, so things are looking pretty good for the future, and hopefully for Q2, for the month of September, this TE forecast of negative 400k will get revised, and possibly a positive figure, maybe back to what it was in February. Okay, so that's non-farm payroll, so looking pretty good for the future in terms of people going back to work and jobs being created. Okay, so now that we know that, now if there was a recession, let's talk about historically what companies do well during this period. As you can see here, this is the top 10 stocks in the US S&P 500 by total return. Okay, so the 1 year total return of these companies was pretty high, as you can see, one being at 60.8 and the lowest one being at 16.8. Okay, amongst the list, the best performing industries are discount stores and medical related companies. You know, discount stores being Dollar Tree, Walmart, medical related companies, i.e. Amgen, I'm not sure if I'm pronouncing that one right, Vertex Pharmaceuticals, Edward Life Science Corporations. You know, these companies have done well during a recession period. This is because people are going to be going into discount stores and people will be possibly needing more medicine. You know, a lot of people being out of work. Now, if we go to my current stock portfolio, like I said before, I use a free trade app to invest in the stock market. I use a dollar cost averaging strategy. For those of you that don't know what dollar cost averaging is when you consecutively invest into the market. Okay, so you can do that once every month, once a week, once every 2 weeks. I do it once a week personally, and I've only been investing in 4 different stocks, as you can see. One being Barclays. I own 392 shares, averaging £1 and 1p per share, and the current stock price as of today was £1.31. I also own 2,071 shares of Lloyd's, okay, averaging about 29p per share. Current stock price as of today was 36p. Okay, so I've been using the dollar cost averaging for these two for the past month or two. Last couple of days I bought these two, Essentra and Hurricane Energy. Essentra, I bought 47 shares, averaged about £3.16, and the current stock price is £3.22. Hurricane being the other one, I've only spent £50 on this particular stock. Okay, I've bought 565 shares, averaging about 8p, and the current stock price is 9p. Okay, so I haven't obviously used a dollar cost averaging as purposefully for these two, as they are new, but have for the two above, Barclays and Lloyd's. Okay, that's the end of the video. I hope you liked it. Please let me know what you think in the comment section below, and I'll see you in the next one. Oh, and please don't forget to share, like and subscribe. Thank you.